Hi, welcome to the Market Alert for Thursday, the 15th of August 2019. So the market's in turmoil, clubbed like a baby seal. Yes, it was a very interesting day yesterday. I spoke about the price action in the daily Dow yesterday. Let's just find this. And we drew in the 76% retracement, and the market sailed through this and also through the 200 bar moving average. But as you can see here overnight, the magnet that is the 200 bar moving average, prices are trying to already get back above this level, so don't be surprised to see this happen. Also, watch the low just in case prices do return to the south side and go through here, then you'll be looking over here. But I suspect they're going to do the best to bring this back today. But we'll mark these up. As I always say, you have to go with what you see, not what your opinion is. But it's always a good idea just to have an idea of what the market could do in both directions. So what I would do here for the upside is the recent high down to yesterday's low. We can't go on to this one because we don't know that this is going to be the low or not, the market gap lower. But this will give you a pretty good idea if the market starts to rally back. And the first sign of any strength coming into this market is going to be a close above the 200 bar moving average. So watch this level closely. So yesterday it was down all the way in the pre-market session as well. You can see how it just hugged the 20 bar moving average all the way down once prices are closed below the 200 bar, and then it got into a rhythm and it was just a one-way bet all the way down. And you can see there all of the sell signals producing profits, all moving lower. And then there was a bit of a bounce here, but the market couldn't even manage 20 points to the 50 bar moving average. We see the potential weakness in the market here, and then prices just continuing to the downside. There was an attempt at the end to try and bring prices back, and also obviously those that were short were buying, which is why you see this bar here with no follow through. And then once the profits had been taken, the selling resumed, and then once again as we move over towards the overnight, you can see some more profit taking, but again it didn't hold until the market gapped lower and then prices moved higher. And I suspect it was probably something to do with Trump bashes clueless Jay Powell and a crazy inverted yield curve, which I'm going to come on to in just a moment. So that's what was behind this. Is sort of to help the market a bit, and overnight prices have moved back towards the upside. And if I just narrow this so you can see, we're heading back towards the 200 bar moving average in the 5-minute chart at the moment. Whether it holds or not remains to be seen. So let's have a look, see if there's any news that will help the market today. No, not really. It's going to require Trump to send out some positive tweets to turn this around today. So let's have a look at the implied volatility. We'll start off with the daily one. We're back to 20.87 there, just slightly higher than the previous drop in the market. And look how far we've moved. We've only moved one bar, and it's taking it from 16 to 20. I think there's still more on the downside here. We're above the 20 bar moving average here. We're below here, which you can see quite clearly in this chart. And I'll just make it a bit bigger. No, it won't work that way. So below the 20 bar, above the 20 bar, and we can see this from previous occasions how and what the market will do. So until we get a 100% increase in implied, the downside is still favored by me. Of course, we're going to get days where we get a bit of a bounce. We saw this on Tuesday when Trump sent out a tweet to say that he wasn't going to impose the tariffs on China on mobile phones, etc. for a while, and that boosted the market. But really there is a problem in this market, and you only have to look at the yield curve Yesterday, the 30-year tumbles below 2% for the first time ever. Not as dramatic as it looks because interest rates being so low, given the 2008 crash and never being able to increase them substantially, that's not too much of a headline. But this one is the 2s and 10s just inverted. This is the first time in 12 years. 2007, the precursor to 2008 crash that we saw in the markets. So again, if you read this article, brilliant article, and goes into explain exactly what we see in all of the other charts that we've got as far as the yield curve inversion is concerned and what the likely outcome is going forward. It also talks about the same thing as what I spoke about before, how many months before you get a recession. This goes into a lot more detail though, and starts looking at 9 out of the 12 recessions, etc., etc. So well worth a read for those of you that like sort of stats and probabilities. But a very, very good article. But again, they're talking the same sort of thing that I uncovered a few months ago in a spreadsheet and looked at the averages. And it's around 1.3, 1 year, 3 months for a recession to kick in. But I think it'll be a bit sooner than that, the way things are going at the moment. I've also brought this back as well today as a special celebration of the yield curve inverting. Again, just to remind you, if you look on the left there, you've got 3 month all the way through to the 30-year. The 30-year should always be higher. Well, all of them should be higher. The curve should be this way, not this way. So as you go through here and look at 2000, you see the yield curve invert with the 3 month way above everything else. You see they're all inverted, precursor to correction there. So not only is the yield curve inversion a precursor to a recession, it also for a major correction in the stock markets as well. Just bring this back and you'll see again, not as obvious, but it's certainly above the 3 months above the 30-year there. And then as we ride through this, you can see that's a normal yield curve. And then all the way through to where we are now, and you can see that it's really starting to invert there. And the easiest way to understand this, because there's a lot of confusion around yield curves, if you think about it this way, in the US you can go into a bank and you can say, I'd like to put some savings into a bond. How much is the 3 month paying? And they say, let's for example say 2%, and say, well, what about the 10-year? I'll tie my money up for 10 years, how much is the 10-year bond paying? And they go 1.5, and you think, well, this is a bit odd. How come I can get a greater return on a 3 month than I can on a 10-year? So it just goes to show you how things have changed dramatically. So that's an inverted yield curve. And as I said, it is a precursor to two things: market correction, the bonds and the stocks decouple, the bonds become a safe haven. You can get a lot of money on the near term. So why bother with the risk in the stock market? And the second thing is a precursor to a recession, because it costs a lot more money to buy short-term loans as well. And Deutsche Bank moving lower as well. Keep an eye on this one. We're heading towards Charles Nenner's $6.40, where he said there could be quite a bit of a catastrophe in the markets if Deutsche Bank hits this level. I don't know why, but we've had this marked up for some time. We just wanted to see if that came to fruition or not. So just a bit of fun there. But given the backdrop of the markets at the moment, nothing would surprise me at all. Meanwhile, Bitcoin, there's not a lot happening in the pound at the moment. But Bitcoin yesterday, we marked up the 76% to the downside because the market looks weak. Prices have rounded over. And we went through this yesterday. So the next downside target is 90.80, which we drew up last week, and the market seems to be heading for this at the moment. 4-hour chart is well and truly below the 200 bar moving average. All the sell signals there, profits as prices move lower, and also in the 15-minute chart yesterday, you can see how things were fairly quiet to begin with, and then they rattled to the downside. Nothing to do with the Dow, and you can see there the first signal failing, but then the short paying off, We had a rally back, and again you can see the buying coming back into the markets here, and once again prices then moving back to the downside. So a nice bit of volatility coming back after the start of the week where it was just spiky, but now it seems to have evened itself out again as the market heads to test this level here. Okay, that will do it for this one. I'm not going to look at the pound. There's not much happening there at the moment. Still waiting to see what's going to happen with Brexit. So it's more or less in the sideways range. And I've already gone on for 10 minutes, but a lot to cover at the moment, a lot going on. And I wanted to give you the backdrop so that you can see how you should be looking out for towards the next 12 months and how to also think about preparing for it as well. Forewarned is forearmed. Okay, that will do it for this one. If there is anything else to report, I will let you know. But otherwise, as ever, thanks for watching. See you in the next one.